So, good afternoon, everybody. Thank you for joining us on FPC's one of FPC's first webinars, which is going to be a series that we're going to hopefully do going forward. I do appreciate that Wimbledon has started and you've given up an hour of your time, so we'll hopefully make this useful. For those who I haven't been introduced to already on the call, my name is Mike Lee. I am the Senior Advisor and Investment Director here at FPC. The aim of today's session is to primarily introduce our independent investment consultant, Tricio Investment Advisors. And on this occasion, I'm really pleased to have Tricio Chief Economist John Calverley here, who is going to give us an economic background and his insights into what's happening at the moment. Now, clearly, the economy is in quite a great state of change at the moment, having been fairly consistent for the past decade or so. And John will discuss some of the themes that that investors are thinking about and markets have shown themselves this year to be concerned about as well. So besides John at Tricio, there are also two other of his colleagues. So there's Chief Strategist Jerry Salea and also Head of Investment Solutions James Chu. And the three of them, including John, they feed into FPC's investment committee and provide economic insight in order to guide our asset allocation for client portfolios. Now, in terms of how this webinar will work, we're all well aware that sitting through 60 minutes of slides and commentary can be challenging. So John and I will hope to keep this fairly relaxed, and we'll get through the slides as quickly as possible to allow for plenty of time for Q&A at the end. You should see a Q&A box on your screen. Please feel free to put any questions you do have. If we have an answer for you, then we can provide one. If we don't have an answer, then we can take the question away, come up with some details and refer back to you later on. So for the moment, I'm going to go on mute and I'm going to ask John if he will introduce himself and Tricio and give a little bit of background.
Okay, thanks, Mike. So just to introduce Tricio and then briefly on my colleagues, Tricio, as Mike says, is a brilliant advisor for professional investors. So as well as independent financial advisory firms like FPC, we also work with family offices, investment managers, and product structurers. I mean, two key things about us, I think. One is that we're independent. We're not selling any particular products or anything like that. We are purely advisory. And the other is that we're quite globally oriented. So for example, if you ask me which economies I follow most closely, it's probably the US first, China second, UK third. That's kind of the way that markets work these days. And so that's what our perspective is. James, Jerry and myself met initially at American Express about 20 years ago and worked together for a while there and then went our separate ways. And we came back together again to form Tricio about 3.5 years ago, I suppose. Jerry is our chief strategist. He's also worked, as well as Amex, he's also worked at Bank of America and Standard & Poor's. And he is a really close follower of markets. And I guess over the last 35 years or so, he's seen just about every kind of market. James is our head of investment solutions. So he's looking at particular ideas to tap into particular investment opportunities. And he's worked at HSBC and a number of smaller firms. He's also an expert on ESG investing. And myself, I'm the chief economist of American Express for about 15 years. And then I was with Standard Chartered, head of macroeconomic research and head of thematic research. And then I branched out on my own about 8 years ago, I suppose, and then formed Tricio with the other 3.5 years ago. So that's us. I'm going to pass back to Mike to talk about the markets, and then I'll talk about economics a bit later on.
Perfect, John. Thank you for that. So FPC and Tricio have been working together now for the past couple of years. Tricio, like I said, they impart their knowledge and experience into our economic input to the investment process. which informs us as to asset allocation. And we're talking about longer term asset allocation. We're not talking about the shorter term gyrations of markets. FPC clients and us as advisors, we focus on the longer term, as all our clients who are on the call will know. I must tip my hat at this point also to Peter Stanier. Now, Peter Stanier is, I'm pleased to say, on the call. And Peter, as many clients will know, has supported our investment committee for many years before he took a slight step back, and he actually introduced us to John, Jerry, and James. So Peter, hello to you, and thank you very much for the introduction, because it's working out just fine. So before passing back to John to do his economic overview, I thought it would be useful to provide some context as to what's happened in markets over the year to date, because there has been quite a sudden change in the economic background and how markets have actually reacted to them. So I'm going to just whiz through a few slides, and there's not going to be too many. Forgive me, I'm going to end the show. I'm going to start from the beginning. Okay, so this is just a brief market update. What we've seen year to date. What are the drivers that are affecting markets and investors? So this is a classic image, actually, and this is from the 1980s, but it's pretty apt for now, because we're entering seemingly a change of economic cycle. However short it might end up being, we're obviously seeing the impact of inflation. We're obviously seeing the interest rates move, having been low for many, many years, and that's changing the landscape that investors have to deal with. Now, for the last 5 months, we've heard about interest rate expectations moving higher, and eventually central banks in the US, in the UK, and recently in Europe have moved interest rates higher. Now, very, very recently, perhaps over the last few weeks or month, we've seen a slight change in sentiment, in that the fear of economic recession is now making investors question whether or not interest rates may not go up as fast as previously expected. So this quote here is apt, because it talks about investor sentiment, which can be a driver of markets rather than fundamentals. And, you know, whatever news flow comes out can really dictate whether markets are up or down on that particular day, week or month. As I said, we talk about longer term performance here at FPC. What I wanted to do is show you what some of the major asset classes have done this year to date in the context of what they've done over the last 10 years. So in terms of this table, we've sorted it by year to date, which is the third column from the left-hand side. And you can see, for the most part, over the last 6 months, we've seen most equity markets fall. The best performing equity market, surprisingly to many, is actually the UK, which is down only 6%. Now, these figures are in sterling terms, and I'll come on to that in a second. But you can see the outlier, the positive performer there, which is the commodities sector. So the commodities sector has delivered 53% performance year to date, which is extraordinary. And we all are aware of the impact from the pandemic in relation to supply chains, and the increased demand that people have, and the unfortunate war that's happened in Russia and Ukraine, and that impacts in particular agricultural commodities. That's led to that particular index increasing significantly. Now, if you look over to the performance, which I put there, annualized over 10 years, you can see that commodities, whilst they've delivered 6 months of very strong growth, over 10 years, you only had an annualized rate of just over 1%. As you go down that list, you can see highlighted in green that North America has delivered an annualized rate over the last 10 years of 15%, which is way above what we would consider to be expected returns. Investors, therefore, have become used to getting 5, 6, 7, 8% returns from equity markets. Now, what I should say from this table, if we look at the third column from the left again, year-to-date performance, is that corporate bonds and sterling gilts, they are down 13 to 14% year-to-date. That's a direct impact of the interest rate expectations and how that impacts the value of fixed interest investments, which we'll come to speak about shortly. So how does that look over a 10-year cumulative performance? Well, for those who know me, have met me, or heard that I'm actually colorblind, so this makes looking at charts like this makes it quite difficult. So I might refer to them as A, B, C, and D, etc. But you can see that line A, which represents the S&P 500, which is in North America, over the last 10 years, it's risen by 341% in sterling terms. That's an extraordinary performance. And the S&P 500 has been the market which has been weakest year to date. So you could probably anticipate that there will be some giving back of the performance that investors have had over the last 10 years. Behind that, the second best equity market, which is B, which is in Europe, as represented by the Euro Stoxx 50, that's up 145%. So the difference between those two markets is extraordinary. This is the year-to-date performance, as I showed before. A being the S&P Goldman Sachs index for commodities. That's up 38% year-to-date in sterling terms, in local terms, and I'll show you the impact of sterling next. So in terms of dollars, that's the return that investors would have had. Besides that, UK commercial property has provided a slightly positive return, but all other asset classes have been negative. This is the 1 year dollar charts to show the strength of the dollar against the three other major currencies, being the pound, euro, and the Japanese yen. So against the pound sterling, which is B, the base, the US dollar has risen by 12% this year. Now that has implications because it makes any positive performance to UK investors greater, and it makes any negative performance less impactful when translating dollar-based assets back to sterling. So for UK investors who are invested in North America, there has been a less worse performance because of the sterling impact. And that's really because of the way that US interest rates have moved, because they've taken the first mover advantage. The US central bank was the first central bank to move interest rates higher, and that's what's caused the dollar's attractiveness for investors, because they can get a better return. But what has led the US market higher over the past 10 years? Well, this is a slightly shorter chart going back to 2014. But what this chart shows is that the black line is an index of highly tradable US technology stocks, of which there are about 8 to 10 in that particular index. I then also show the middle line, which is the S&P 500 information technology sector, and then also the broader S&P 500 index, which shows the wider US economy. So you can see that those 8 to 10 technology related shares have really provided the majority of the returns that US investors and international investors have had. And we're talking about the well-known Teslas, Amazons, Microsoft, Facebook, those kind of shares. Now, unfortunately, what goes up must come down. And that's what we've seen year to date. We've seen those gains that have accumulated, actually, they've been given up quite quickly by those particular companies. Now, those companies, and this is a theme that's talked about quite a lot, is those particular companies are considered to be growth companies. So what do we mean by growth companies? We mean companies that have high valuations today for profits that will only be received by investors way in the future. So these are companies that might be investing, building up, not paying anything in the way of dividends, but investors' returns are going to come by way of earnings, any dividends many years down the line. This particular chart shows the difference between growth and value being the opposite of growth. We've got companies that have high cash flows, pay high dividends, and do not necessarily have the same growth outlook going forward in terms of their earnings per share growth. So two very different kinds of companies. And this has been the relative performance. So you can see since July 2012, the MSCI World Growth Index has returned 280%, whereas the MSCI World Value Index has returned 175%. And the majority of the outperformance came in July, around 2015 to 2016, but really came about during the pandemic in 2020. That's when those technology companies became very attractive to investors. Year to date, however, that trend has reversed. So anybody who's investing in what you would call old industry types of companies, energy, utilities, etc., they've actually had, despite wider markets being down significantly, they're only that particular index is only down just over 1%, whereas the World Growth Index is down 18%. Again, a very large divergence of the companies within world stock markets that are doing well as compared to those that aren't doing so well. So the question is, why has that happened? Now, we all know about the inflationary pressure that we've been seeing at home, in the workplace, within our businesses. Inflation is starting to grab hold and be reflected in many parts of our purchasing life. Now, that inflation took off, and in response, the expectations of the market to interest rates going forward have risen significantly. So you can see here that in January 2020, in fact, if we say July 2020, a 10-year government gilt, if you invested money with the government in the UK for 10 years, you would have received a return of 0.1% before tax per year for the next 10 years. And that's when inflation was nowhere to be seen, and interest rates and investors were not expecting interest rates to move anywhere. How quickly things can turn. And here we are in June 2022, and a 10-year government bond will now give you 2.3%. So a significant change. And the fact that lots of risk assets like company shares trade off the back of what the risk-free rate from a government gilt will provide you, you can see why the impact to other asset classes has been so significant, because that move is a very, very sudden move. And it's all to do with how the central banks fight inflation. Now, so much depends for future markets on the path of inflation and the path of interest rates going forward. And I'm going to pass over to John now, and hopefully he's going to be able to give his economic insights as to how markets, what markets have to contend with going forward.
Okay, thanks, Mike. Let me try to share my screen. Okay. Okay, there we go. So what I'm going to talk about today, in probably the next 20 minutes or so, I'll talk about inflation, because that's obviously a key issue, as Mike has said. We'll talk about interest rates, how high will they go, and then look at this risk of a recession. As Mike says, people are starting to worry more about a recession now than they were a few weeks ago. And last year, they weren't talking about it at all, really. So it's happened quite quickly. I also want to talk about a couple of other topics, which I know people are interested in. One is Brexit, 6 years after the vote. And finally, the house price outlook, which I think is interesting in its own right, but also will have an impact on the economy more broadly as well. But first, just worth looking at where we are in terms of economic output. So this is gross domestic product. Red line here is the US, and I've started this in the fourth quarter of 2019, just before COVID. So you can see that we've come in the US above that level now, but in the UK, the blue line, and the Eurozone, the green line, just about back where we started. So we've recovered from COVID, but we haven't really gone very far forward beyond it, except perhaps in the US, which has done best. The US, of course, did more fiscal, more government stimulus, and more monetary stimulus than other countries. But of course, inflation is the big issue at the moment for economic policy and also for markets. Here I've got the UK Consumer Price Index, which is about 9%, the Eurozone Consumer Price Index, about 8%, and the US Personal Consumer Expenditure Deflator, it's called. Bit of a mouthful, but it's the one the Federal Reserve watches, and that's about 6.5%. So jumped up dramatically. These are the highest levels of inflation we've seen really since the 1970s or early 80s in these countries. So it's been quite a shock all round. And of course, it's having a big impact on the economy and on policy. Economists like to look at core inflation, taking out food and energy. And of course, the core inflation is lower because quite a bit of the inflation we're seeing is due to energy in particular, but also food. You can also see that it looks as though this might have turned down, at least in the US and the UK, turned down slightly in the last month or two, but it's very early days. But nevertheless, this is high too, and it's a big concern. So back last year, the central banks, when inflation first started to go up, they said it's transitory. It won't last. It's due to special elements like energy, like cars, and like food. And so I wanted to show you there's a lot of truth in that, even now. Central banks are not saying that anymore because it is wider than this. But nevertheless, this is a big factor. So for example, in the US, energy prices are up about 35% over the last year. The price of used cars is up about 17%. That's because there aren't any new cars to be had. So people are bidding up the old ones. New car prices have gone up. The dealers are not offering discounts anymore, and list prices have risen. And food prices are up, and in particular in recent months because of the tragedy in Ukraine. I include one more down there called shelter, which is basically rents. Now that's not transitory, and rents are rising quite fast. And rents are quite a big part of the price index. So that is going to tend to keep inflation running high for a while. But some of these other more transitory elements will go into reverse. And this is a slightly complicated chart, but again, using the same 5 categories, the green bar here shows what you'd expect in terms of the contribution to the consumer price index if we had 2% inflation all round. So for example, new vehicles should be adding about 0.1% to inflation. In fact, they're adding about 0.5%. And used vehicles also should be adding about 0.1, but they're adding about 0.7% to inflation. And so on, and energy, of course, is the big one, adding nearly 3%, nearly 3 percentage points to the price index. So those 4 transitory elements account for 5.4% of inflation over the last year, out of 8.6%. So if they stop rising, inflation comes down quite quickly, not all the way to the 2% target, but it comes down quite quickly. And it's possible that some of these prices will actually be negative for a while. They'll actually fall. Used car prices, in fact, have started to fall a little bit. Energy prices may fall. It's going to depend on Ukraine and other factors. But there's a good chance that inflation will come down on its own to some extent, and possibly more than you might expect if some of these things go negative. Another reason for thinking that inflation will come down is that money supply growth is slowing. Now, I'm not a monetarist economist, and central banks are certainly not monetarists these days. They don't really look at it at all. But if you look at the growth of US money supply in 2020, early 2021, it grew at over 25%. And frankly, when that happens, usually you do see inflation picking up. So I think it was a mistake for the central banks not to pay more attention to that. We also saw quite fast increases in the UK and the Eurozone, not as outstanding, but quite fast. All those increases are coming back down again quickly. And that's, I think, positive for bringing inflation down. Where I think the concern is now on inflation is that wages are rising. And if wages rise, then there's a danger of getting into a kind of wage price spiral. And so the reason that the central banks are raising interest rates and really trying to slow economic activity down is because they want to make sure that wages don't get out of hand. This is something called the Atlanta Fed Wage Tracker, which is a good indicator because it shows the same workers year on year, whereas some of the other indices just sort of show averages. As you can see how much it's increased, and this is not consistent with the 2% inflation rate. You need this to come back down to about 4% to be consistent with the 2% inflation target. We see something similar in the UK where wage growth has also picked up. It's a slightly different pattern, partly due to COVID. But again, you can see that wages are rising quite quickly, and the Bank of England is concerned about this. So what really drives wage inflation and how can they bring it back down? Well, it turns out the two biggest drivers are the level of unemployment and also the pace of change in unemployment. And let me show you a couple of charts on those two things, the level and the change. So here's the US unemployment rate. It's at a 70-year low. One of the reasons for that is that workers have disappeared since COVID. We don't quite know what's going on. We know some people have retired early. We know some people may be off sick with long COVID, but there just aren't as many people in the labor force as you would expect. And that's also driven unemployment quite low. So this level of unemployment points to real pressure in the labor market. And indeed, we see that on lots of other indicators, like the number of vacancies or the number of people offering a job. If you look at the UK, you've got a 50-year low for unemployment. Again, same sort of story. There's some missing workers, probably long COVID, early retirement, etc. But it means the labor market is very, very tight. What about the change in unemployment? This chart needs a bit of explaining. The red bars here are the recessions in the US, and the blue line shows the change in the unemployment rate from a year earlier. So you can see that during the red recession periods, unemployment rises, typically between 2 and 4 percentage points. In the 2008 recession, it went up about 4 percentage points. In the COVID recession, it was a bit special. A lot of people laid off. It actually went off the chart here, that the number went up to about 6%. And then, of course, after COVID, the economy bounced back and we saw unemployment fall very, very rapidly in the US in 2020-21. But you can see that even in the latest year, unemployment has fallen about 2 percentage points. And again, when employers are trying to find people, when they're advertising, when they're trying to encourage people to come, wages tend to go up. So this is a very, very hot labor market, and that's a big concern for the central banks. So they're raising rates, as Mike said. The US has started to raise rates in 50 basis points, 0.5% intervals, and it's got up to 1.75% now. UK is being a bit more cautious because the British economy is already slowing down quite a lot, but they are raising rates. The Eurozone has started to raise rates and will raise in July. Market interest rates, of course, have risen in anticipation of this. So as Mike said, we've seen big rises in bond yields, both at the short end, the sort of 2-year, 3 years, but also at the long end. Obviously, the big question people are asking is how high will these rates go? If you look at the US first, the red line, you can see in the last cycle before COVID, interest rates were up at 2.5%. Looks like we'll be there very shortly, probably over the summer, over the next couple of meetings. And then the question is whether they go up higher to 3, 4, or even higher. My guess is they won't, that actually the economy will slow down. I'll talk a bit more about that in a moment. And the UK will continue to raise rates slowly, and so will the Eurozone. And in this environment, markets are nervous. They don't know how high interest rates are going to go. And they also don't know whether it's going to trigger a recession or not, which is a big concern because that affects profitability. So here's the market expectations. Market's expecting about 3% for US short rates, about 1.75% for the UK, and about 0.75% for the Eurozone. They still sound quite low for people like me. We've been around in the 80s and 90s, but especially the Eurozone, but of course they're negative at the moment in the Eurozone, so that's still quite a big change. How much they actually rise is going to depend on economic activity. And in our view, activity is slowing quite quickly. The UK and the Eurozone are probably already in recession. In fact, that's caused by the rise in energy prices, which is such a big shock. The US had more momentum coming into 2022. And also the energy shock isn't so severe there because electricity prices and natural gas prices haven't risen as much. But the US is slowing down now. So I think the central banks are going to be watching what happens to activity, how much it slows down. And they're also going to be watching how quickly inflation falls, and in particular, wages. That's going to be a key factor to watch over the next year or so. So we think inflation will come down later this year and into 2023. There's still a question mark as to whether it's going to come all the way down to 2% or even 2.5%. I think central banks would be happy with 2.5%. But if it's still at 3 or 4%, then they won't be happy and they'll still want to be leaning on the economy, I think. This is just a chart to show what's happening in the US. I could show you a lot of different charts of things like employment and retail sales and industrial production and so on. But I think the best way to summarize it is to look at what's called the leading indicators index, which looks at particular indicators which usually move first or move early in the cycle. There's about 9 or 10 of them, things like new orders, consumer confidence, the stock market itself, various other things. You can see that it's just started to turn down. That's the top line there, the blue line. Early days yet, but that's clearly a sign the economy is slowing and slowing quite quickly. And I would expect this line to come down further in the next few months. So recession or soft landing? I think that's the question that people in the markets are asking themselves right now. So the red bars are the recessions. The blue line is the federal funds rate, the US interest rate, the dark blue line. And the light blue line is the inflation rate. You can see I've put some green S's there, 4 of them. And these are what I think were the soft landings we've seen. So I think there's been about 4 soft landings and about 4 recessions over the last 40 years. So on that basis, it's 50-50. You can debate about whether these are all soft landings or not. Certainly the 1983 experience, the 1994 experience were, because there wasn't a recession despite a lot of Fed tightening. In 1986, interest rates were raised and there wasn't a recession until 1990, 3 years later. So I think that counts as a soft landing for the economy, although you may recall that there was also a stock market crash in 1987, and that was really part of the story. And then in 2018, we had a rise in interest rates, and I would call it a soft landing. We did have a recession in 2020, but I think you can blame that on COVID. We'll never know for sure, but I think it's unlikely there would have been a recession in 2020 otherwise. So I think the Fed achieved what it needed to at that time. So we have been saying 50-50 for recession versus soft landing. To be honest, if anything, I've probably shifted a bit more to the risk of recession, just the events of the last couple of weeks. The fact that the Ukraine war is dragging on and shows no sign of ending. The fact that natural gas prices have risen in the US quite a lot in the last couple of months. And just the data as we see it come in. The Federal Reserve is being very hawkish, we call it, very strong, very determined. And I think sentiment is turning. So it's very difficult to predict these things, and we don't attempt to do that because we're looking really for the long term. But there's certainly a risk of a recession, still a chance of a soft landing. My feeling is that if we did see a recession, it would not be anything like as bad as 2008 or as 2020, the COVID one. I think consumer balance sheets are stronger. I think business balance sheets are stronger. The banks have a lot more capital. We're not going to see a financial crisis this time, I don't think. So if we see a recession, it's more likely to be something relatively mild, but it could still count as a recession. Okay, I want to switch gears quickly and talk about Brexit and then housing. So first of all, on Brexit, this is a chart showing investment, gross fixed capital formation. You can see that the US and the UK were basically in line with each other since 2000, more or less. But since about 2018, the US has gone out in front. And the vertical line there shows the referendum. The referendum result led to a lot of uncertainty. People held back on investment plans, and it took a year or two for that to impact the UK. Obviously, investment tends to be planned ahead. But you can see from about 2017, 2018, investment in the UK stagnated while it was rising strongly in the US. And then during the COVID period, it fell, and it hasn't recovered. So it still hasn't recovered back to where it was pre-COVID, whereas the US is well ahead. And I think the uncertainty around how the Brexit would work out, we didn't know exactly what kind of deal we would have for, 3-4 years. And even now, there's still uncertainty as to how it will all work out. So that's holding back investment. And holding back investment is bad news for growth in the short term, because that's obviously spending, which drives the economy. But it also reduces the potential for productivity growth, because it tends to be investment that drives productivity, new machines, new ways of working. So it's still early days. Not all the import checks are happening yet. We still don't know exactly what's going to happen with some of the service sectors. There's still negotiations going on. There's obviously the Northern Ireland Protocol, which is hanging over the issue. As I mentioned, overall investment is down. One thing that's been quite surprising, though, is that inward foreign investment has actually risen. And I think that's certainly surprised me, because we thought that foreigners wouldn't invest in the UK because it would no longer be a good base for Europe. But that doesn't seem to be the case. And that's encouraging. It means that the UK is still seen as a good place to invest, and maybe a good place even for a European headquarters. So that's promising. Trade is down. I'm not going to go into that because it's quite a complicated story, but UK exports and imports seem to be lower than they otherwise would be. And that's exactly what you'd expect when you put up barriers to trade within Europe. And living standards are down. And I think there's not much doubt about that. We don't know exactly how much higher they would be without Brexit, but they do seem to be down. And one of the reasons for that is the lower pound. Mike was talking about that, but it goes back really to the referendum. This is the sterling dollar exchange rate. If you look back historically, there tended to be a range between about 1.4 and 2 for sterling dollar for many, many years. When it got to 1.4, it generally started to go back up again. But since the referendum, 2016, we've seemed to move down into a lower range, something like 120 to 140. And a lower pound means you have foreign goods are more expensive, and basically it lowers your standard of living. So that's I think, the biggest change, really. The effects of Brexit over the longer term, frankly, we still don't know. This is going to take years to work through, and it's obviously going to depend on policy in the UK and how things work out. Most economists think living standards will be lower than they otherwise would have been, but exactly how much, we don't really know. Somewhere in the 1% to 4% range, I think, probably captures most people's views. Much of this has already occurred, so that's perhaps good news. And it's come through the fall in investment and the fall in sterling. What drives it also is lower competition and less investment. I don't think trade agreements with non-EU countries are going to help very much. The government talks about this. It's done a couple of deals with Australia, New Zealand. There's a deal with India coming. The deal that would help most would be with the US, especially if it got into services as well. There's no real sign of progress on that. I don't think the Biden administration is interested. It's not interested in trade generally, and it's not interested in helping the UK, I suspect, as well. So I don't expect very much help from that. What could help is if we saw a lot of deregulation. That was one of the hopes, really, of the pro-Brexit campaign. We really haven't seen that yet. It's not easy to do in practice. And there's also the question, thinking longer term, is would a new government try for a softer Brexit? Certainly not the Conservative government, but that won't be in forever. It's possible we could move to some kind of softer Brexit over time, but that would be some way in the distance. Let me very briefly, because I want to leave some time for questions, talk about house prices. We've seen this very strong rise in many countries, not all, but many countries, and especially in the last couple of years during COVID. And that's driven by the particularly low interest rates, but also the extra demand for space. You can also see in this chart the pronounced cycle in the UK and the US. So prices peaked around 2007, 2006 in the US, 2007 in the UK, went down. This is in real terms, so it's after adjusting for consumer prices, and then have come back up again and look pretty high. And when we look at valuations, this is the ratio of house prices to rents, and it's based on 100 being the average of the last 40 years. So for example, Canada is about 110% now of its average of the last 40 years. So Canada has really gone up a lot. That's probably exaggerated slightly because Canadian prices were rather low in the 1990s, but nevertheless, it's gone up a lot. Australia too, UK is third, France is quite high, US and Germany at about 30% above the average. And this is really, to a degree, justified by low interest rates, because we're moving away from that now. So there's a real question as to whether these valuations can survive. So in terms of the outlook for housing, well, first of all, it's a key channel for monetary policy. It always has been. Whenever central banks raise interest rates, obviously that affects the mortgage rate. People can't borrow as much, and then that affects the number of transactions in the market. So people don't spend as much on furnishings, on household appliances. It also affects house building. So we see fewer housing starts. So it's usually one of the early movers in the economic cycle, and indeed we are seeing that. But it's quite a recent phenomenon. I would say weeks even rather than months that this has started to happen. But it's definitely happening. And at Tricio, we've been doing some work on this for clients, and we think that we can see quite a big fall in prices in some countries, particularly the US, Canada, Australia, and Germany. Probably rather less in the UK, and that's partly because the supply of new homes in the UK is so low. It's going to depend, how it works out will depend on a lot of things, including if we get a recession, how bad the recession is, how high interest rates go, and perhaps also most importantly, whether interest rates stay up. If having come up to 2 or 3%, they stay in that kind of area in future years, or whether they go back down again to near zero. Very hard to predict, but that's going to be a key factor. Okay, I'm going to stop there. There's me and my three colleagues, and I'm going to hand back to Mike for questions.
Perfect, thanks, John. That's great. There's so many important things that you've just spoken about. I made a note regarding the house prices and the 10-15% fall that we could see in the UK. Seems to me like in a lot of cases, fundamentally, there might not be an enormous shift in what's going on at the moment. Those 10 to 15% price rises, we've seen those over the last 12 months, in some cases. So it feels a little bit like taking the froth out of the market, whereas fundamentally, things might not have changed that much. Human beings, we extrapolate what's happening recently into the future. So, investor sentiment has turned slightly negative. It doesn't necessarily mean it's going to continue, even if we get a short recession. So we could surprise ourselves over the coming year. So yeah, we've got some time for some questions, of which we've got a couple that have come through, and one of them probably, John, is for you. Well, certainly it's for you. And one probably I'll handle as well. Seeing as though you're in your flow at the moment, I will pass the first question over to you. And the question really is about the government deficits and how can central banks raise interest rates given the predicament that governments are in regarding the deficit that came from the pandemic?
Yeah, it's a good question. I mean, I think if interest rates keep rising, and if we also see slower economic growth, then governments are really going to have a lot of problems with government deficits. If you remember, this is what happened in the 1970s, where the UK went to the IMF at one point for help because of government deficits. So, but the question really is whether central banks can raise rates given this. I think they will still go ahead and raise interest rates, and governments will just have to sort themselves out. And it's going to be tough because at that point, they may need to actually cut back on spending. And that, of course, will add to any potential economic downturn. And how that plays out, of course, it may be you get some government cutbacks on spending or rises in taxes, but that means that the central banks don't have to raise interest rates quite so much. So it's going to be a sort of a balancing act. But yeah, it's going to be an issue, I think, over the next year or two.
Okay, perfect. Thank you. So the second question we've got is really what role does fixed income now play, or fixed interest now play in a portfolio? One for me probably. So fixed interest investments have fallen in value over the past 6 months. Fixed interest investments are quite unusual really in the sense that, or rather the capital growth we've seen has been quite unusual. When you buy a fixed income, you're buying exactly that. You are buying the right to an interest flow over a set period of time, and then you're going to get your capital back. The fact that the value of these fixed interest investments has gone up over many, many years is directly related to interest rates coming down. There's almost a byproduct and something that investors have almost come to expect, that the part of their portfolio which traditionally is defensive is actually providing growth in capital values. I think we went beyond the point at which that was reasonable, and as such, the 13-14% retracement in values that gilts and bonds have seen over this, the past 6 months is a reaction to that. However, bonds still have, there's still a very key part of the portfolio. The correlation with company shares has been high recently. But if we do get to the point where we enter a recession and it's not soft and the recession is slightly harder, that will impact, as John said earlier, the profitability of companies. If the profitability of companies falls, then share prices will fall also to reflect that. You're going to be glad that you had fixed interest investments within your portfolio. And also, you should never forget that these fixed interests they do have redemption dates. So when you invest, you are going to get your money back at a particular point in time, subject to the credit quality of the borrower. However, once that money comes back, the investor is then free to invest at whatever the prevailing interest rate is in the market at that time. So interest rates have risen and investors will get better returns on reinvested money as well. So bonds still have a part to play in a portfolio for sure. So we're now, hopefully that answers the question, we're now 10 to 3. There's no more questions coming through. If there are any, please put them in the panel and we can answer them later on. We can follow up. So that really comes to the end at the end of the webinar. But to sign off, I think FPC's view on investment markets is that we've been saying that we haven't expected past returns to carry on into the future. We have expected volatility to come back. We do expect volatility will be here for a while whilst all of these questions are being answered in the world economy. But whilst we showed you the 10-year return as well, and we don't necessarily worry too much about what happens over 6 months or 12 months. That's a game that FPC doesn't really play. So what we do want to make our clients, our investors be aware of is that returns are not linear. And in one particular year, you may receive 15% plus on part of your portfolio. Another year, you might receive -4% of the portfolio. Just because you've had that bad year doesn't necessarily mean that you need to have a knee-jerk reaction to what's happening in the economy. We always say the best thing to do is probably to take a step back and have a look and see whether or not these investment returns are going to continue, but the history will tell you that markets are more than likely probably going to be higher in 5 years than they are today. That's what the market data will tell you. So to hang on is probably the best thing to do. And in terms of FPC's principles, we've always kept cash and investments separate. So we like to think, albeit we can't change human instincts, we like to think that our investors, our clients, do not worry as much because they have sufficient cash reserves as part of their financial plan already put to one side. So regardless of what happens in markets over the next 6, 12 months, 18 months, there is no call on that money necessarily, and they can afford, and our clients can afford to ride out that volatility. And that's the message we try to get across all the time. So I hope that you have enjoyed the webinar. There will be more to come. On behalf of John and I, thank you very much for attending and listening to the opening games at Wimbledon. If you do want to follow up at any point, please don't hesitate to email myself, mike@fpc.co.uk, or your advisor or planning team here at FPC. So thank you very much again, and have a good rest of the day.